In today's episode, we're going to look at how to grow your money. Welcome to episode 5 of the Financial Coach podcast. My name is Mark Corkery and I'm the Financial Coach. Today I'm looking at how to grow your money. So the main types of retail investment in Ireland are deposit accounts, life company collective investments or gross roll-up funds, direct shares in listed companies or equities, direct government or company bonds or fixed income, or direct property stroke real estate. In this episode, we're going to just look at these investment classes. So first of all, let's look at deposit accounts. You can get deposit accounts from banks, credit unions and building societies. Usually investment return potential is very low. Deposit accounts are useful for emergency funds and meeting short-term goals like holidays or funds to change your car. Access to your funds is good unless you have a fixed term investment, say for 1 year or 2 years, and they are simple to understand. Life company collective investments or gross roll-up. These investments are usually provided by life companies like Irish Life, Zurich Life, New Ireland, Aviva Life and Standard Life. You buy units in the various funds that the life companies have. Each fund has different risk and return profiles, and you can pick the one that meets your investment needs. While you can have access to your funds, it's probably best to invest for a minimum of at least 3 years plus in these types of investments. They target higher returns than deposits over the long term. Direct shares in listed companies or equities. You can buy shares in companies listed on stock exchanges, usually through a stockbroker. If shares are held for a long time, there is potential for investment returns above inflation. Shares by their nature are volatile and can rise and fall in value. You can sell shares at any time to get your money back. The amount you get back depends on the value of the share at the time. Direct government or company bonds or fixed income. When you buy a bond, you lend money to the government or company that has issued the bond. In return for that money, the government or company provides you with a bond and promises to repay the value of the bond when it matures. The government or company also promises to pay a specified rate of interest on the money you have invested. Access to your funds is usually limited to the end of the investment return. You can sell them before the end of the loan term, but you might get back less than you lent to the government or company. Returns are usually better than deposits and closer to the rate of inflation. Direct property investment or real estate. You purchase the property yourself, and it can be commercial or residential or a mixture of both. You will receive rental income from the property, and any growth or loss in the value of the property will be totally yours. If you want to get your investment funds back, you generally would have to sell the property, and this may take time. Over the long term, investment returns from rent and capital growth have the potential to be higher than inflation. Comparing various asset classes. Asset classes are the types of assets you can invest in. They are mainly made up of the following classes: equity, fixed income, real estate, commodities, and cash. You can own any of these asset classes directly or through an investment structure like gross roll-up funds. Before investing in any asset class, you should understand the characteristics of each class. Ownership structures. You can own your investments in a number of ownership ways, such as individual ownership, joint ownership, partnership, or a limited company. What ownership structure you use will depend on your own personal circumstances and will involve considering items like marital status, inheritance planning, and tax considerations. Expected return, risk and time horizon. You've probably heard the phrase before, risk versus return. What this term is saying is that the higher the risk involved with an investment asset, the higher the potential reward. However, along with the potential for higher returns, investing in shares usually brings higher risk, volatility, and the potential for the investment returns to vary each year. The further you go out on the risk axis, you have the potential for higher investment returns. However, the further you go out, you also have the volatility of values. For example, shares have the greatest potential for long-term returns but can be volatile in the short term. Deposits have the least risk but the lowest potential for long-term returns. The longer the investment term you have allows you to consider more growth assets like shares. Your time horizon. Your time horizon is the length of time that you can allow your investment funds invested before you need access to them. Generally, the longer your time horizon, the more risk you should be able to consider with your investments. So long-term investment growth depends on the amount of risk you're willing to take and the time horizon of your investment. In order to try to understand risks with your investments, we have listed some examples, such as market risk, liquidity risk, concentration risk, credit risk, inflation risk, horizon risk, and longevity risk. Market risk. This is the risk of investments declining in value because of economic developments or other events that affect the entire market. The main types of market risk are equity risk, interest rate risk, and currency risk. Equity risk applies to investment in shares. The market price of shares varies all the time depending on demand and supply. Equity risk is the risk of loss because of a drop in the market price of shares. Interest rate risk. This applies to debt investments such as bonds. It is the risk of losing money because of a change in the interest rate. For example, if interest rates go up, the market value of bonds will drop. Currency risk. This applies when you own foreign investments. It is the risk of losing money because of a movement in the exchange rate. For example, if the US dollar becomes less valuable relative to the Canadian dollar, your US stocks will be worth less in Canadian dollars. Liquidity risk. The risk of being unable to sell your investment at a fair price and get your money out when you want to. To sell the investment, you may need to accept a lower price. Concentration risk is the risk of loss because your money is concentrated in one investment or type of investment. When you diversify your investments, you spread the risk over different types of investments, industries, and geographic locations. Credit risk. This is the risk that government entities or companies that issue the bond will run into financial difficulties and won't be able to pay the interest or repay the principal at maturity. Credit risk applies to debt investments such as bonds. You can evaluate credit risk by looking at the credit rating of the bond. For example, the long-term German government bonds have a credit rating of AAA or AAA, which indicates the lowest possible credit risk. Inflation risk is the risk of loss in your purchasing power because the value of your investments does not keep up with inflation. Inflation erodes the purchasing power of money over time. The same amount of money will buy fewer goods and services. Inflation risk is particularly relevant if you own cash or debt investments like bonds. Shares offer some protection against inflation because most companies can increase the prices they charge to customers. Share prices should therefore rise in line with inflation. Real estate also offers some protection because landlords can increase rents over time. Horizon risk. This is the risk that your investment time horizon may be shortened because of an unforeseen event. For example, the loss of your job. This may force you to sell investments that you are expecting to hold for a longer term. If you must sell at a time when the markets are down, you may lose money. Longevity risk. This is the risk of outliving your savings. The risk is particularly relevant for people who are retired or near retirement. So as well as understanding what we've covered so far in the podcast, growing your money is about 5 key actions. Save as much as you can. Save and invest for as long as you can. Get the best investment return suitable to your risk tolerance. Put the right mix of investment assets together and try to minimize costs. Thank you for listening to episode 5 of the Financial Coach podcast. See you in the next episode.